All right, we're just proceeding with the enhancing qualitative characteristics. We've taken a look at the fundamental characteristics, that is relevance and faithful representation, and now we are back to enhancing qualitative characteristics, just like this. Now, as I just told you, our main point in enhancing is they just make financial information more useful. So this is the point. Fundamental make information useful, but enhancing make the information that already has fundamental qualitative characteristics to be more useful. Because they are already useful, we just need them to be more useful. We have 4 characteristics here. The first one is comparability. We'll take a look at that, no worries. We have understandability. We'll take a look at that again. And let's take a look at them all first. We have verifiability. And lastly, we have something called timeliness. Now, let's go and take a look at one after another. By saying comparability, when preparing the financial statements, let's say you're prepared for 1 year, the financial maybe for last year and for this year should be comparable. If you go to the income statement, we usually know that the income statement has started with sales and then cost of sales. If you go to that line of cost of sales, it should be the same. For example, let's say you decided that the depreciation should be added to cost of sales, right? If you did add depreciation to cost of sales in the last year, then you are expected to do exactly the same in this year, so that when you compare those cost of sales figure, you have a clear picture. Not that, oh, last year I added them to cost of sales. I added depreciation to cost of sales. This year, depreciation is separate, or maybe depreciation is added to administration expenses. No, that's not allowed. Comparability becomes difficult. And that's why we say information is more useful if it can be compared with similar information about other entities and with similar information about the same entity for another period or date. From the example I've just stated, I've assumed that I'm dealing with different periods, last year and this year, so for the same entity. But also, if when you compare yourself to another entity, but let's say for your company, depreciation is usually added to cost of sales. But for the other company, depreciation is added to distribution cost. Then you cannot compare those figures because they would mislead you directly. Otherwise, you have to make an adjustment first before comparing them. So it's just like that. And that's also there should be consistency. This is what I've said, that if you did something last year, do the same this year. So there should be consistency in the comparability. And by consistency, what do we mean? Consistency simply means the use of the same methods for the same items, either from period to period within the reporting entity or in a single period across entities. So it's just like that. Right. Now we have something called understandability. These are just simple, normal matters. Understandability. The financial statement should be prepared in such a way that people can understand. If someone takes the financial report and they read, they should be able to understand. They do not need to be accounting experts to understand. This is what we're just trying to explain. That's why we say financial reports are prepared for users who have a reasonable knowledge, just reasonable. Not necessarily to be very competent, no, just a reasonable knowledge of the business and economic activities, and who review and analyze the information diligently. So that's what is very essential when making the decisions here. I don't know what's happening here. Hello?
Hello?
Yeah, I just find that my cursor of the PC is just, the screen is just turning black. I don't know. I don't know what's wrong. Let me see this. The screen is, I don't know where I've clicked. Do you just see fine everything?
Okay, it has come back.
It has come back. Now on my side, there is a resolution. I think the resolution, I don't know, the resolution has changed, but I just changed nothing. Now I don't, but do you see everything in a fine way?
Yes, I'm seeing
let me try to do this.
It's off now.
Yeah, now it's off. The resolution has kind of changed. Now I don't know why it has done that. Or maybe let me just try to proceed this way. Let's try to proceed the same way. But I don't know what's wrong. the resolution has just changed. It has kind of shrunk. I don't know. I've never experienced this. All right,
It
now,
has come back.
yeah, let's just proceed. On my side, is just like, anyway, you can just proceed, no problem. But I just wonder whether I'll be able to scroll because the screen has turned in a very different way. The resolution has just switched itself off. Yeah, all right.
You need to
Let's just proceed. Let's
look
just
at
proceed.
it to fix it.
No, let's just proceed because if you can see properly, you can just proceed. So,
Okay.
as I just said, when speaking of understandability, financial reports are prepared for users who have a reasonable knowledge, not to be an expert. Reasonable knowledge of business and economic activities, and who review and analyze the information diligently. All right. So, classifying, characterizing, and presenting information clearly and concisely make it understandable, right? If you classify something properly, maybe these are assets, these are liabilities, these are non-current assets, these are non-current liabilities, and making a proper presentation is sufficient. We usually say this: do not exclude something that is complex just because you are afraid that the users will not understand, right? If something is just complicated and there is no way to simplify, just include it as it is. We know that it won't be easily understandable, but if the users really seek to understand what is explained in there, they should seek the experts. They should make use of the experts so as to understand better. So this is a very, very important point too. All right, and then we have something called verifiability. Verifiability, we just mean that the knowledgeable and independent observers, maybe you have people who have knowledge and they're independent, that's like no one can influence the other. They could all reach a consensus. That means they could come to the same conclusion, although not exact, but actually they should be converging to the same solution, right? But not necessarily a complete agreement that a depiction is a faithful representation. Everyone is given the financial statement, they say, oh, this one is a faithful presentation. This is a faithful representation. Everyone says that, and then you say, oh, that's fine. But lastly, we say that there is something called timeliness. You know, by timeliness, we just say that having information available to decision makers in time so that they can make decisions. Let's say you have been late to give the financial statement to the users who maybe could have decided to withdraw their shares and invest somewhere else had they received the financial statement or the annual reports in advance in time. So you have to consider time. If you give someone the proper information but out of time, that means that won't be useful, right? Yeah. All right, now we are just on another section called underlying assumptions. What are the underlying assumptions now? What are the underlying assumptions? When dealing with the financial statement, when preparing financial statements, there is an assumption that we usually make right here. And for the current conceptual framework, there is just a single underlying assumption. Financial statements are prepared on the assumption that the entity is a going concern. This point is very, very essential. This point is very, very important. Going concern, this is the underlying assumption. So we presume that whenever you prepare the financial statements, we presume that there is a going concern. By the going concern, we assume that the entity will continue operating for the foreseeable future. This foreseeable future is usually considered to be the next 12 months that are on the date of the issue of the report. We expect the entity to be able to proceed for the next 12 months, right? This is what we usually presume. And if you say the foreseeable future, we mean that the company will continue its operation. That's why the true meaning of the going concern is that we assume that the entity has neither the intention nor the need to liquidate or curtail materially the scale of its operations. I don't know if you got this section that I've just explained bit by bit. You know, the way the company is closed down, if the company is going to be closed down, then it's not a going concern, right? And now, if you need to close down the company, there are two reasons. It's either you have just decided or you have no alternative but to close it down. For example, In case you have negative equity, if assets are less than liabilities, then the company is insolvent, the company is kind of bankrupt, and so it has to be closed down. It has no option. That's why you have voluntary and involuntary liquidation. That one is an involuntary liquidation because whether you need or not, we have to close down the company, right? So that's why we say the entity has neither need. This is the need. The entity has neither need. Need, that means whether you need or you want or not, it has to be done that way. No intention. Intention is just like, oh, we are tired of this of business A. We need to establish business C. So let's close down business A and start business C. That's why we say that, oh, business A is not a going concern. That's why we say that the entity has neither need nor intention to liquidate. Or you may decide not to fully liquidate, but if you are just curtailing, if you are just reducing the scale of operations in a material manner, let's say you as the company had 78 branches, but you are just going to close 75 branches and remain with 3 branches. Oh, we say that there's an issue of going concern there. You cannot close 75 branches out of 78. Even the investors could make different decisions regarding that. So that's the meaning of going concern. So if this assumption is not accurate, then the financial statement should be prepared on a different basis. We usually say that, management is responsible for preparing the financial statements. So management usually need to assess the appropriateness on whether they should use going concern or not. So after assessing, if they find out that, oh, this entity won't be a going concern, then we usually use a breakup basis. We call it breakup basis. By using the breakup basis, we presume that the entity is not a going concern, and so it could be liquidated just in a few time, in a little time, maybe less than a year. In doing that, will mean that all non-current assets, are assets that stay for more than a year. I expect it to stay for more than a year, right? So if you use the breakup basis, all non-current assets become current assets, and all non-current liabilities become current liabilities, and we value them differently. We usually value them at the breakup basis, or we can call them piecemeal value. You just value them at the amount at which you can just dispose it and then pay off those investors. So that's what we speak of the underlying assumption. So whenever the financial statements are prepared and nothing is stated, we presume that they are prepared on a going concern basis. All right, now we are on another section called elements of financial statements. Now, how do we deal with these elements of financial statements here? Okay, so the elements are just the building blocks of the financial statements. The good example is when dealing the statement of financial position, we usually have assets, we have liabilities and equity. These are the elements of the financial statements, especially statement of financial position. When dealing with the statement of financial performance or the income statement or the statement of comprehensive income, we usually report income and expenses. So the other elements of financial statements are income and expenses. Now we are just trying to go to the real financial statements now. Okay, so here we learn the definition of the assets, liabilities, equity, income, and expenses. I believe that you have something, something about this. And now, what is an asset? An asset, an asset is used to generate economic benefits, right? So an asset is a present economic resource, is a resource controlled by an entity, not necessarily owned, controlled, just not this point, controlled, not necessarily owned by an entity as a result of a past event. Something occurred in the past and now you have to you control something. Maybe you purchased. The past event is like, let's say you purchased a machine. And currently, it is a resource. So it is a present economic resource. You are controlling it because it's all that you purchased it. It's yours. But you might not have purchased something. Let's say you just took a machine under lease. If you take it under lease, it would be in your books, you would use it. And now, of course, you won't have to record the machine as your asset because it is not yours. But by leasing, we mean that you have obtained the rights to use that one. So you would record an asset as the right of use asset. You would obtain the right of use rather than the asset itself. So that also would be an asset. All right. Now, we spoke of economic resource. What do we mean by economic resource? An economic resource, just like, it's just a right. It's just a right that has the potential to produce economic benefits. Let's say you have a machine. You have a machine and you're controlling it. You have the right that has the potential to produce economic benefits. If you use it, it can give you economic benefits. So that's what an asset means. All right. And then we have something called a liability. A liability just means an obligation. Now take a look here. We say it is a present obligation of an entity. Now this one is an obligation. An asset is an economic resource, but the liability is an obligation of the entity. So it's an obligation to transfer an economic resource. If you say you have the present economic resource and maybe you expect economic benefits, that means you get it from some people. And if you have a liability, that means you have already been given something. And that's what we say as a result of a past event. Maybe you borrowed something. The supplier gave you goods on credit. You are yet to pay. This is a past event. The past event has created a present obligation of the entity to transfer an economic resource. I hope you know what we mean by obligation. Obligation, it's just a duty that you cannot waive. You do not just decide whether to waive or not. You cannot waive. All right. Maybe you could just. I believe that you know this one, but let's just speak of them. When speaking of examples of assets, we have current assets, like I just said there, machine. You can have current assets, or maybe you can have things like investment properties, which are landed buildings, for example. You can have intangible assets like goodwill, brands, software, websites, things like that. And then you can have current assets like inventory, trade receivables, or we usually call them data. You can have cash, you can have bank balances, you can have prepaid expenses. And then there are liabilities. And examples of non-current liabilities could be what? Could be maybe you have the long-term bank loans, you can have debentures, you can have loan notes, you can have bonds, things like that. And about current liabilities, a supplier has given you goods you are yet to pay. We call them trade payables or creditors. You can have the bank overdraft, things like those. We can have the accrued expenses. The year has ended, you are supposed to have paid something up to that point, you are yet to pay. We say this is an accrued expense. Someone has paid you, you are supposed to receive $2 million by the end of the year, but you have actually received $3 million. That means someone to whom you provide the service has paid you in advance. So you have a prepaid income. If you have a prepaid income, that means you have a duty to deliver service to that guy. And so a prepaid income is also a liability, just like that. Okay. And now you could see something like this here. Definitions of assets and liabilities, all in the conceptual framework, all speak of the word present, here present and here present. That's why we say the conceptual framework is not a standard. We saw that on the status page, we saw that deferred tax asset or liability relate to future, not to present, but they are allowed because the conceptual framework is not a standard. It cannot override a standard. Okay, and now the last component, in the last element in the financial statements is the equity in the statement of financial position. I mean, equity is just asset minus liability, the normal accounting equation, right? That is what we call equity. So we say that equity is the residual interest in the net assets of an entity, just like that. So it's no big deal over there. And then let's go to income and expenses. Now we are on income and expenses. Now, the new conceptual framework has explained income in the form of assets and liabilities. It's just very, very clear. When assets increase, we say that if assets increase, you obtain an income. If liabilities fall, you also obtain an income. So we say that income means increases in assets or decreases in liabilities that result in an increase to equity, right? Let me tell you one thing here. When you prepare the income statement, you would have the profit for the year. That profit for the year usually goes to equity. You can have what profit for the year maybe in other comprehensive income, then you can have total comprehensive income. We usually take that total comprehensive income and take it to equity in the statement of financial position. If you have ever prepared the financial statement, you would realize that. You have prepared the income statement for the year, you have obtained $100 million, you take that $100 million and add them to the equity at the beginning of the year. So simply speaking, income will always increase equity, while expenses will always decrease equity. So that's why we say income with the increases in assets or decreases in liabilities that result in an increase in equity, but very specifically, excluding contributions from equity holders. Do you mean by this? What do you understand by this? Excluding contributions from equity holders. You know, there are things that pass through the income statement and then they go to equity. That value of income, that profit of the income statement goes to equity, right? But there are things that go directly to equity. That's why we say excluding contributions from equity holders. For example, suppose a company issues shares, the shareholder subscribes to such shares. The subscriber would give cash to the entity, the entity would debit cash, and then it would credit share capital. Now, do you see that share capital does not pass as income in the income statement? It directly goes to the statement of financial position. That's why we say this one would not constitute income. I don't know if you got me up to that. So, simply speaking, this definition of income has been explained in terms of asset and liability, just that way. And maybe I could add something here in form of double entry. You could just realize, you know, when saying income, you mean assets have increased or liabilities have decreased, just intuitively. But also you can want to know one thing. There is something that is very, very useful, and maybe I should tell you right now. You have to understand the nature, the debit and the credit nature of all these items here, right? You know, in a business, you can make expenditures, but also you can receive something. Now, if you make expenditures, you can do a capital expenditure or a revenue expenditure. But when you receive something, you can also receive, you can have a revenue receipt or a capital receipt. So simply speaking, if you have an asset, that means you have incurred some cost, you have incurred some expenditure. So assets and expenses are of a debit nature. If you can do that, you better write it aside, because that's what we'll be dealing with when dealing with IFRSs and IASs. Assets and expenses usually have a debit nature, while liabilities, income, and equity usually have a credit nature. When speaking of debit and credit, right, this one is very, very essential. Because when I explain the standards, I usually refer to double entry. Double entry is taught at the very preliminary stages, but it's a basis. You know, even in a CBR, especially in consolidation, it's very, very essential. It eliminates a lot of questions. Okay, so liabilities, equity, and income would have a credit nature. That's why if you define here, we say that an income with the increase in assets. You know, if assets increase, assets have a debit nature. So I would debit the assets. So the corresponding side would be to credit income, right? Decrease in liabilities. Liabilities have a credit nature. So if they are decreasing, that means you have debited them, you have gone opposite. You have debited the liability, that means the other side will be credit. So you find yourself that you are dealing with the nature of the income, which is credit. All right, let's go to expenses. Now, expenses is just the reverse of income, right? If you have an expense, that means an asset has decreased or liabilities have increased. So you can just say if the decreases in assets or increases in liabilities, that result in decreases to equity. So obviously, an expense would reduce the profit. If profit is reduced, it's reduced, and the profit goes to equity, equity would also reduce. So would also decrease, I mean. So decreases in assets or increases in liabilities that result in decreases to equity, specifically now excluding distributions to equity holders. Now, not one thing. You know, a company can say pay dividends. If the company pays dividends to ordinary shareholders, to those equity holders, that dividend will not be shown as an expense, will not appear in the income statement. that dividend would be deducted directly to equity. Just like up here, when we say if a shareholder, for example, contributes something to the entity, that goes, maybe he subscribe to shares, those shares directly go to equity. They do not pass through income statement and then to equity. No, they go direct, they are reflected directly to equity. The same for expenses here. If maybe a dividend is paid to ordinary shareholders, it won't appear in the income statement, but it would go and reduce specifically the equity, which is usually the retained earnings. You know, retained earnings is one of the components of equity, right? Retained earnings is simply the accumulation of profits and losses over the years. So that's what will have to be done. All right, and now we can just go to another point. Let's just go to another point here. Actually, I've done very well. You know, we are just at page 5. You've done very well. Very, very nice. Okay, recognition and the recognition of the elements of financial statements. Now, what do we mean by the term recognition? This one is very important. By saying recognition, we mean that you have recorded something in the income statement or statement of financial position. You say revenue equals to 200 million. I've recognized it. You say property, plant, and equipment equals to 600 million. That's what we call recognition. Something appears on the face of the, actually something appears in the financial statements, right? Yeah, just like that. So that's why you say by the term recognition, we mean the process of capturing for inclusion in the statement of financial position or statement of financial performance. This is a statement of profit or loss, an item that meets the definition of one of the elements of the financial statement. So be it equity, asset, liability, income, expenses, that's what we call recognition. Now, before proceeding, I would like you to know the difference between recognition and disclosure. You know, when someone tells you disclosure, even in the literal meaning of disclosure in English, by disclosing mean that making something open, right? Just being open, making things obvious to others. So, if you recognize something, since you have said, let's say, oh, property equals to 600 million, it's obvious that I've disclosed it. I've disclosed it, but I have not recorded. Oh, I've disclosed it, but you know, the financial, we have in the financial statement, we have several sets. We have the statement of profit or losses we saw there, statement of financial position, statement of cash flows, statement of changes in equity, as well as the notes to the financial statement. If you go to the notes and they specify maybe how equity was, how maybe PPE, property, plant, and equipment was calculated, we say that you have disclosed in the notes. We have just disclosed, we have not recognized. So recognition should arrive at these financial statements up here, not the notes. Okay. So I can just proceed this way here and we say an asset or liability is recognized. Now, you know, there are specific standards which explain how to recognize an asset or liability. This is just a conceptual framework, as I just told you. So usually we should recognize an asset or liability only if recognition of that asset or liability and any of the resulting income and expenses or changes in equity provide users of financial statements with information that is useful. I think you have done this already. The conceptual framework said that you do this if it will give the information that is useful. If the information isn't useful, why should you waste your time? And this is what we learned about the qualitative characteristics of financial information, and we said you have the fundamental. So simply speaking, this one should reflect the fundamental qualitative characteristics, which you said are relevant information as well as faithful representation. So not much here. You just have to note here about these fundamental qualitative characteristics, which we explained before. But for the standard itself, actually, we would have to know maybe when dealing with property, plant, and equipment, what we have to do. When dealing with the recognition, what we have to do. Okay, and then we have something here. We have something here called the recognition. The recognition is just simply the opposite of recognition. If you recognize something, but now you do not have, it does not have to be in the books, you just have to recognize it. You check it for certain condition to recognize it, but now it does not meet such condition. So you simply remove it. For example, let's say you have an asset, maybe you have transferred to someone else. It's no longer yours. You had an asset, you have sold it, it's no longer yours, then you have to recognize it. That's why we say It is the removal of all or part of the recognized asset or liability from the entity's statement of financial position, right? Just like that. And so they say it normally occurs when the item no longer meets the definition of the asset or liability. For example, for an asset, when would this be the situation? The recognition normally occurs when the entity loses control of all or part of the recognized asset, right? You have lost control of the asset, maybe through selling it, through transfer to someone else, through share exchange, things like those. And for a liability, it's obvious the liability. If you pay, that means that you have extinguished the liability, right? You are no longer liable. So for a liability, the recognition normally occurs when an entity no longer has a present obligation for all or part of the recognized liability. You have paid, maybe someone has come and told you, oh, I've forgiven you, do not pay me. Although I doubt someone would come and say that. Okay, so we are the other point here, that is measurement of elements of financial statements. All right, when doing the measurement now, you cannot recognize something without being able to measure it, right? Let's say you say, oh, I bought PPE, I bought property fund, or maybe I bought property. That property, oh, all right, you bought it. For how much? You do not know. Or someone has just given you property and you need to recognize it. Oh, that's right. That's right. You have an asset. It's very right. But at what value should you recognize it? You do not know. You cannot determine even its fair value. That means you cannot recognize it even if you have it. So that's what we speak of measurement here. So when dealing with measurement, we just say that, or when dealing with measurement, we just say that measurement is the process of determining the monetary amounts at which elements of the financial statement are to be recognized and carried in the statement of financial position and the statement of comprehensive income, which we usually call the income statement. All right. So the measurement basis is usually classified into historical cost and the current value. There are several ways of being able to value these, to measure these items, right? There are several ways to measure these ones. That's why we say we use historical cost and the current value. Now I'm just going to take a look at all these. Historical cost, I think this one is very, very obvious. Let's say when you are purchasing a plant, maybe, or maybe you're purchasing a machine, you paid for something. So it's obvious. So this definition would cover for assets and for liabilities. So that's why we say historical cost measures provide monetary information about assets, liabilities, and the related income and expenses using information derived at least in part from the price of the transaction or other events that gave rise to them. So simply speaking, when dealing with historical cost, it's like you take a look at what you spend to get something, right? That's why you say for an asset, it is just the value of the cost incurred, cost spent in acquiring or creating the asset. You could have bought, or maybe you could have constructed it yourself. So it could be to create it, comprising the consideration paid to acquire or create the asset plus transaction cost. Obviously, you paid for something, then maybe you had to pay for extra transaction cost, and you have it. And for the liability, it is the same now. If the asset, you acquired the asset by paying something, and then we say you incurred the liability by receiving something from someone, right? So liability, historical cost of the liability, is the value of consideration received, not paid now, to incur or take on the liability minus the transaction cost. So it's for liability, you say minus transaction cost. If you pay your cost, you debit cost, and then maybe if you pay, you credit cash and you debit that cost. But the liability has a credit nature. That's why that debiting of the cost would reduce the liability. And that's why we say when we define a liability, we say minus transaction cost, while for the asset we say plus, because an asset has a nature of debit, and transaction cost will also have a nature of debit. And then you have the second category, that is current value. And this current value is usually divided into three main components. Current value simply speaks of it provides monetary information about assets, liabilities, and income and expenses using information updated to reflect conditions at the measurement date. So when dealing with historical factors, they reflect the past, right? But when dealing with current value, it's new information. But it just since it really changes on how that new information is obtained, that's why you have three different categories. And those categories are here. First of all, you would have fair value here. And second, you would have value in use, or sometimes called, if an asset, and if it's a liability, it's called fulfillment value. And the third, you'd have this current cost here. So by having the current cost, then we'd have to define all these three points. Then after here, I think everything would go very, very well. So this is what we have reached so far, and now we can just take a look on how to proceed with our situation. All right. There a question, let's say, any question?